The event will begin shortly. We are waiting for all our guests to join the event. Thank you for your patience. Hi everyone, my name is Nosheen Zainab, and it's my pleasure to welcome you to KiwiTech's Angel Investors panel. Today we have a fantastic panel discussion on current state of fundraising, exploring the current landscape of fundraising in the startup ecosystem, followed by four high-value growth stage startup presentations. I am joined by my colleague Ekant Chaudhary. The two of us will serve as the moderators for the event today. With that, I would like to welcome our Associate Director, Strategic Partnerships at KiwiTech, Karandeep Sori, to give a quick overview of the company.
Nosheen, thanks a lot for the introduction and giving me the opportunity to present, KiwiTech in front of esteemed guests today. Um, Andrew and Dan, just allow me 5 more minutes for the introduction, and then we can have the video cameras on, if that's okay. Uh, all right, so just a second. Let me know whenever you can see my screen.
Sure.
Um, all right, perfect. Can you see my screen, Nosheen?
Yes.
All right, great. Well, everyone, welcome to today's event. Well, KiwiTech is an ecosystem, a global community of innovators, investors, mentors, enterprises, and of course, startups. And we today we stand at 600 plus portfolio companies as a part of KiwiTech family. We built an investor network through the networking annual events that we've been hosting of about more than 3,000 plus investor network, through which we've supported our partner founders with 150 million over 150 million US dollars in capital raise. Now, we also provide mentorship as a as a part of our ecosystem, where we have more than 300 mentors, and we host a lot of workshops through them, and absolutely at no cost, of course. And since we are the world's largest tech in exchange for equity platform in the world, we've also invested more than 150 million US dollars in tech services as an investment. As I mentioned, the investor network and all of this comes together through the ecosystem of events that we built. And today we host around 80 plus events on an annual basis. Now, where it all started was in 2012, where our founders of KiwiTech had a pretty successful exit from their previous company, which was called Aptara. Now, it was a content technology company. They scaled over 2 decades into a 5,000 employee organization, and exited at 144 million US dollars. And in 2013, we launched the KiwiTech Startup Program. In 2017, we started the efforts of helping our founders with the fundraising through the events. And by that time, we were already a 100 plus portfolio company. And in 2019, we started with additional support, such with events such as Startup 808 series, where our mentors stepped in, and we also expanded to the Middle East region. In the last 3 to 4 years, we've expanded into a 600 plus portfolio organization. We've hosted more than 200 events till now. To expand our service offerings, we even acquired Graphite Financial, a New York-based financial company, especially serving the startup ecosystem for early to growth stage startups specifically. And we also acquired WebMob. Now that's a Web3 center of excellence. Trying to build that. So we acquired this company as well. So by 2026, we are on track of becoming an ecosystem of 1,000+ portfolio companies, and we're really targeting to have at least 100 portfolio companies to exit at a minimum of 100 million US dollars. And now, if I talk about a partnership model that makes us the world's largest tech and exchange for equity platform, is basically that we really step in with the founders and split the risk on technology development by giving them an option to pay for the technology development in part 50% in cash, and the rest of the 50% of the payment comes in form of fair market warrants to us, and it's a non-debt instrument. So here's the example. Say over the 2 to 3 year period of partnership with KiwiTech, the scope of technology development work is $500,000. The founders can pay $250,000, of course, in the course of that 2 to 3 years agreement or engagement in cash, and the rest of the $250,000 would come in form of equity, giving us a bit of skin in the game, motivating us to really create quality products and helping our startup founders grow. So that's really the value proposition here. This is the deal flow, typical deal flow for the past 4 years, the number of companies that we've reached out to, the portfolio companies that ended up engaging with KiwiTech in terms of technology development. But of course, a lot of these companies are a part of the ecosystem in terms of getting the access to the investor network that we built. But it is again exclusively for the KiwiTech ecosystem. As a part of the KiwiTech ecosystem, the stakeholders are obviously our portfolio companies, which play a prominent role in our ecosystem. We have the investor network. We also have partnered with a lot of incubators, accelerators, and have a lot of corporate communities as a part of, again, the whole family. We provide technology development as a part of our main service offering. That's where our heritage lies. We have a team of more than 500 engineers, and all of them are in-house on a payroll. We built about more than 2,500 products till now. We also acquired Graphic Financial, as I mentioned, to really expand our service offering into finance and accounting. We also have digital marketing within the organization to really help our founders take their products to the next level, and hit their milestones. And also, we have the Web3 Center of Excellence, and we are also working towards AI and ML excellence as well. All of this has come together because of the local partnerships that we've had, but also the ecosystem support through the global capabilities that we built. Now, as I mentioned earlier, all of this comes together through the events that we host, such like the one that you're at today. And we host a variety of events. We categorize them to make it very relevant for everybody, the investors and the startup founders, by categorizing them as per community specific. For example, the female founder demo day, or the Hispanic founder, or the Black entrepreneur matter demo days, but also as the stage of your business, or the region or the industry that you're in. So I really welcome everybody today for an angel investors panel. We have a great panel with us today, and some great startups to really look out for. So good luck, and I hope you guys enjoy this as much as we did, bring this to you. So thank you so much. Thanks a lot, Noshi, for the opportunity.
Thank you, Karandeep. And with that, without further ado, I would like to introduce our panel moderator of the event today, Philip Weber. He is the NASIX Associate at Game Angels. Philip, the screen is all yours.
Thanks, Noshi. Really appreciate the introduction. Super happy to be here. This isn't my first KiwiTech event, so thanks again for the invitation. For everyone here, I work for Game Angels. We are the world's largest and most active venture capital syndicate that prioritizes DEI and how we do business. We want to create a space for allies, advocates, and underrepresented investors and founders to access the top quartile of VC. In about 10 years of doing business, we now today have about 2,500 portfolio companies, 4,500 investors in our private network, and an additional 10,000 on AngelList. That's where I myself work as an associate, and it is a pleasure to be here. We've got some really interesting topics of discussion today, and we're looking to best understand the state of venture capital today from a fundraising perspective. We've got some wonderful folks on our panel, so I will very quickly kind of move into intros for folks. Andrew, you're the first person I see on my screen, so I'd love for you to start off with some intros for our panelists.
Yeah, sure. My name's Andrew Romans. I'm a general partner at 7BC Venture Capital. We typically invest in tech startups with between 100K and 500K of monthly recurring revenue. The focus is the US. We also invest in Canada, no hardware, no healthcare life science, and we like things that are leveraging, if not creating, artificial intelligence.
Dan, how about you?
Yeah, hi everyone. Dan Ellis here in Austin, Texas. I represent a family office called Sure Ventures, in addition to my own angel investing interests, where I've deployed about capital into 60 companies. We're mostly sector agnostic, but I would say that we skew towards recurring revenue models, SaaS, B2B, consumer SaaS. I'm also an experienced startup mentor and advisor. I've been actively doing work for Techstars, the Alchemist Accelerator, and several other organizations. And happy to be here today and looking forward to the pitches and the talk.
Awesome. Mark, how about yourself?
Sure. Good morning. Good afternoon. I'm Mark Freka. I'm the one of the co-founders and the current president of the Chemical Angel Network. Chemical Angels is a 12-year-old angel network. We actually started virtually. So we've been, doing Zoom and WebEx for over a decade. Our investment sector is really the hard sciences. We look at materials, measurement, manufacturing. About half of our deal flow is medical device and IVD related. That falls into the measurement, and a lot of medical devices are really enabled by the materials that they employ. We look for deals with valuations under 15 million. We've done north of 50 deals now. Last year or the year before, we kicked off our first fund, and we're looking to invest the balance of that fund over the next 6 months or so.
Awesome. Thank you. And last but not least, Mohammed.
Hello and good afternoon, good evening, everyone. Mohammed Ahmed here with Start Equity Ventures. I'm the co-founder and GP. We began our VC firm back in 2022. We really were focused on impact startups, SaaS. We try to stay away from the hardware side of the house, and we focus more on the SaaS platforms. We're bullish around tech that serves a purpose and leverages AI. I think that's going to be a critical component for scalability. We do invest in startups in the 15 to 40 million valuations, although we have gone up and down stages. So we're looking for founders that have strong conviction and purpose and looking to make an impact with the startups they're investing. We're really vertical, industry agnostic, but we try to stay within 3 or 4 areas that we specialize, that we've got some specialty in, but we're eager to definitely tap into those ideas and founders that have conviction on the problem that they're solving. Thank you, and good luck, everyone.
Awesome. Thank you very much for all those great intros. For the audience's own point of reference, a few points of discussion today we're going to try to cover with our questions. Things like understanding current investor preferences given the market, regional disparity awareness in the kinds of investors that are looking at business from all over the world, which I know are represented through KiwiTech. Perhaps a slight discussion on alternate funding sources beyond the traditional institutional venture capital investors. Light touches around best practices. The impact of the ongoing market conditions that we all understand to be challenging as a kind way to define it. And other small things like, understanding the role of ESG in pitches and what current investors are looking at when they're doing their own due diligence. So I'd like to start off this discussion with the more macro touch point of really sort of getting a feel for, what are some recent trends that all of you have sort of observed in the broader economic market, the venture capital market more specifically, and sort of how that can be challenging to navigate as a potential founder looking for investment. So, Mohammed, I'll kick it back off to you since you were the one that introduced yourself last, and would love your thoughts on just generally, how you've seen the market change over the past few months and how you see it evolving moving forward.
No, thank you for that. I think we're seeing a trend back to where we were back in 2019. I think a lot of the startups saw funding spike incredibly in 2020, 2021, where a lot of the funding peaked. in 2023, we start to see the investments and evaluations start to normalize back to the 2019 trends. And now in 2024, I think there's an opening now of dry powder that's sitting on the sidelines looking for these startups that have a sustainable model, right? I think where we in the past the focus was on growth, right? Show us the growth, show us the number of users. Now it's also including, well, show us the sustainability, right? Can you become profitable? I've seen some of these startups go from the pre-seed and seed extension rounds, something that in the past you wouldn't see as much before Series A, and you're starting to see more extensions happening. We're also seeing some of the startups that got funding back in 2021 really close up shop in 2022, 2023, right? So I think those, and this goes back to those impact startups. There's a lot of investors looking to invest in impact startups that are either in the sustainability or in the geo and healthcare space. I think these are key areas that I've seen a lot of funding goes towards: health tech, ed tech, and so that's something to just be aware of. And the other thing is LPs are a lot more timid, right, in terms of where they're going to invest, and they're kind of taking a step back to take a look at, are these startups going to show sustainability? Are they going to show some of the increase in revenue and be able to sustain kind of the headwinds that we're seeing, right? And I think I'd like to hear some of my colleagues here on the panel and their thoughts, but hopefully that helps.
Anyone want to hop in?
Yeah, maybe I could follow on that. Mohammed, I think you've really hit on probably the main topic for the last couple of years, kind of this spike in valuation and now a renormalization. And I think we're really starting to deal with the repercussions of that, right? So, things like the health tech, I think the valuations are significantly dropping. A lot of the companies aren't going to be making it through these subsequent raises. ESG, it's a component, but not the driver for investments. And then the biggest repercussion is subsequent rounds are going to be down rounds. For people who have an existing portfolio, that could be very painful. You're going to see basically your stake in a company being washed out. However, if you do have dry powder, a lot of these down rounds are insider rounds, and so the folks who really take the hit when it's an insider round with everybody participating, a lot of times is the founders. And so the founders are personally going to take a loss in equity. Yes, there's going to be a increase in the option pool to cover some of that, but those founders, what they were expecting, they're not going to continue on that trajectory.
Andrew, Dan, any thoughts off of that one?
Yeah, those are really. Go ahead, Andrew.
No, you go for it.
Yeah, no, I completely agree with the assessments of the other panelists. I think that's very accurate. I think I would maybe add to that what we're seeing is like a real bifurcation in terms of who's raising and who's not raising, and that's happening across stages and verticals as well. It would come as a surprise to no one here that AI is sucking up a lot of the air and oxygen in the room and the capital. So like with respect to deals being done at those levels, they're actually happening quite swiftly. And late stage is still kind of a mess. I mean, there's a huge backlog there. We have 1,000 unicorns in waiting to essentially sitting in a traffic jam. That market needs to find a way to clear. I think, and that's a real fundamental problem in venture right now. So how do we get these across the finish line? Just speaking more generally about the macro environment, I'm not sure we're going to see any pivot in interest rates anytime soon. I think we could be in this environment for a good time yet. Could be another year before we see interest rates start to go down. And so I see us in a protracted venture reset environment, definitely at the late stage. A little more optimistic at the early stage, which is where I play, so I have to be. And I think there, there's a recognition that, it's going to take years for these to play out. There's great opportunities to be had. There's amazing companies being founded. And that's definitely where we're playing. And especially the excitement around AI is continuing to drive momentum. And the valuations have been pretty robust. I've definitely seen them like kind of come down from where they were in the fall, but not substantially so. Nothing like late stage.
Yeah, so I would say it really depends on the stage. When you have a market correction and the stock market crashes like it did with the Putin invasion in 2020, the stock market falls like a knife. That's real time. Late stage that was trying to be last money in before going public, that has an instant smack and that drops nearly like a knife. The funds that were trying to pass their company into a series DEF are like, whoa, what the hell? And everyone was saying, first half of 2021 and into the summer, the valuations were higher than the terminal exit value of the company for the most part. So you begin to see a tale of two cities or bifurcated, like Dan was saying, that for some companies, you're like, you know what? I'm going to slow down my spend and tip into profitability, take a note from Elon Musk and get rid of all these people I don't need. And I'm going to extend my runway until I grow into this valuation. That means they're not going to exit. They're not going to M&A. There's not going to be an IPO. And this created a real problem that there's very little recycling of GP VCs returning LP capital. So their cadence of saying, I'm back, it's been 2 years, give me another multi-billion-dollar fund. They're actually having a tougher time than some of us emerging managers because they didn't return the money at the usual pace. And so, like, that's an even bigger problem. I think that they're afraid of being zombies. And so a lot of these funds, they didn't just raise their last fund, or saying, let's slow down our deployment pace. So a round that took 2 weeks with no DD is taking 6 months. So plan on 2 quarters for raising your next round. So that means if you're going to fund a company for a 24-month runway, you better 4x, 2x revenues in 12 months, raise that round within 6 months. So you had a 6-month buffer. When you come down from like pre-IPO late stage, it seems like everyone's a little further disconnected from the memo of the stock market crashing. And they're like, hey, I'm not going to mark my Series A down. I think it's still worth 80 billion or whatever. And so you even have like the VCs less concerned about the healthcare of the kids that work for the founders. And they're like, oh, no, we're going to hold tight and hold the front line against all this pressure of downward pressure on the valuation. We're realists. We're like, screw that. Price it so we get funding. This guy can sleep without headphones on at night, knowing he can meet payroll. So it kind of moves down. So you kind of have a tale of two cities, something super 0 to 1 million in 5 months of revenue. All the funders are chasing that hottie. But in general, there's less recognition of the memo of the stock market crash. There's a lot of kind of new funds that are doing series, pre-revenue investing that like never got the memo. They're like, oh, I love a 30 million uncapped note, post money safe for no revenue. 30 million to make a 10x, you'd have to get liquid with no more funding at 300. There's going to be funding. So you got to get liquid at, 600 to make a 10x, which doesn't impress my wife and kids or my LPs. So we're still not really seeing a correction on real seed across the market in places like Silicon Valley. And there's kind of a tale of two cities of who's realistic and who's not on how you're going to price your deal to get funded on pre-seed or a little bit of revenue. And the graduation rate of who's going to get to that A as those funds are pumping the brakes because they had not returned money, is interesting. So it's definitely worth getting a lot of advice and talking to some people before you just go running out of the gates. Better to not even talk about valuation. Just say, these are my capital requirements. This is what I'm raising. I want to get as much talent in the orbit of this company. And you shouldn't really be on the cap table if you can't add value. How much, you tell me what the valuation should be.
Thank you for that. I love sort of everyone bringing a different point of speaking from the syndicate perspective. We can certainly appreciate a heightened sensitivity for investors on moving from growth to sustainability as a core focus of the business proposition and the investment proposition. Also really appreciated the points on later stage investing. That's something that I myself didn't have as much visibility on. So very interesting. I'd love to then sort of shift with that in mind to a discussion around for founders, how important is having a clear and compelling value prop for investors today. When seeking fundraising, what should be the emphasis of a business's, core values? Andrew, I'd love to start with you because you were almost segueing into that with your previous answer. What are investors looking for today from founders when they're sort of approaching you for an early stage opportunity? Is it outlying growth metrics? Is it sustainable P&L sheets? What are we looking for?
Philip, you in your first question, you were saying, what are some alternative financing sources for startups? Do you want to go there? Because we didn't really get at that. We just talked about macro or address this new question.
I'd love to get on that towards the end. I feel like starting off with understanding, what investors are looking for today could be a more productive segue into that, but we'll definitely discuss that at some point.
Well, I think at the end of the day, most VCs are, have a target of what kind of, cash on cash DPI multiples. So at the end of the day, it's going to be distributions to paid in. So if you have a $100 million fund and you 3x that fund in the end after management fees and everything, you're top decile, sadly enough. If you're a really early stage seed investment fund, LPs tend to want to see a 5x cash on cash return. And it takes a while to get there. It takes a long time to get there. If you're investing kind of a Series A fund, you're looking for like a 3x cash on cash return. And if you're investing in a growth fund, like the opportunity fund, investing in the growth rounds of your earlier deals, or that's your entry point, that's who you are, you're just a growth fund, they're honestly looking for a 3x. Now, this is what they're trying for. If you hit any of those, amazingly, you're top decile. And of course, our fund is like 6x, 7x, but normally that's what they're shooting for. So if you're the founder and you go in, like one of my LPs called me with the deal today saying, MRR, monthly recurring revenue, 70K and a 75 million pre, which, is crazy, right? You'd have to be at 1.5 billion if we get 50% diluted or more. And that's just like, upside down wrong. So I think that when you're communicating with an investor, understand that the pre-seed or seed or late stage seed guys are looking to 5x the fund after siphoning out 2% times 10 years. They probably have 25% management fee, if not 20. So like 20 million out of 100 million fund is going to management fee. So they're going to invest 80 million and try and return 500 million. So if you price it as like this and expect there's going to be 20% dilution in late seed, 20 in A, and 10% for maybe 7 more rounds or 5 more rounds to get to a big outcome, are you really better than YouTube? There's definitely inflation on exits. There's no question about that. Multi-trillion balance sheet buyers. I believe that's true. But, one should be mindful of, am I dealing with the guys that are seeking to 5x the fund, 3x the fund, or, or even 2x that fund? On a $1 billion fund, if you 2x it, that means they return 1.2 billion after 12 years. They return that 1 billion and they get 20% carry on the 200 million of profit. So they get a 40 million payout for horrible performance. So those guys are, if you can safely show a 2-3x, you're closing, With us, we don't look at anything for under a 10x return. So at the end of the day, every startup is unique, every human is unique. So they shouldn't all be the same by any means. I think it was Dan who said, if you're lacking a lot of AI in your story, you've got, headwinds up, pouring on you. We've got great companies in our fund 1, 2, and 3 portfolio that should have not a big problem to raise money. And there's just no real AI story there, but they're really good businesses and they're having a tough time. If anyone looked at the last batch of Y Combinator, holy shit, that was like 400 companies saying, we're going to use AI to get your dentist appointment. It was crazy how it was like 98%. And that's a little bit of a signal that it's dangerous investing in something that 98% of the VCs in the disco aren't going to do it.
I can concur to that VC batch. 98% is probably even a generous estimate for the amount of companies focused on AI within it. Let's say your company not working in AI and price sensitivity isn't necessarily a concern for your investors. Dan, Mark, Mohammed, any thoughts around the core business principles you think that investors would want to see or want to highlight in being pitched to?
Kind of weigh in on that. I think just like generically, and kind of to build on Andrew's point, it's just we really like to see founders that have a venture-sized narrative around the startup. And I think this is one of the single biggest errors that I see founders committing, is like not really thinking deeply about their markets, where they're operating, and painting a picture for venture investors about their company being able to operate at large scale. And so I really would encourage founders to really think deeply about growth. If you're going to go the venture route, like, can you get a triple, double economics behind your growth to get you to that unicorn scale? Because it doesn't work for us as venture investors otherwise. Like we need the big home runs to make up on the inevitable losses that are going to happen in the rest of the portfolio. It's a game of power laws here. With respect to kind of the metrics we look for, like we're definitely like kind of no compromise investors. We like to see high growth, double digits month on month for the early stage companies. At the same time, we want great retention, and we want to see net revenue expansion. Like I said, we really like founders with a big vision, and I'd say founders that have a characteristic of grit, that are going to be able to run a venture company, and founders that they make success sound like a fait accompli. Like they are already thinking about how to expand to the next thing. I love founders that kind of have that element where they're already 3 steps ahead. They already think, I've solved this problem in this market, and we're moving to the next thing. So yeah, that think big vision for sure is like important.
Yeah, if I could follow up, I think Chemical Angels is a little bit different from the other folks here on the panel. We're an earlier stage investor. We're not looking for revenue. We're not focusing on that profit loss statement, because there isn't profit. These are pre-revenue companies. Where we tend to focus is really around the value proposition. What's the problem? What's the solution? And then most everything else derives from that. Do you have a protectable position? Is your IP strong? Is this something that can scale? We're also looking for that 10x plus, but we're going to have a lot more technology risk. We're going to have growth risk. We're going to have subsequent financing risk. We're going to have employee retention risk. So we're dealing with a lot more risks and a lot more unknowns being on the early side. But I think that problem solution is where everything starts at that early stage.
Yeah, and I think
anything you'd like to add?
I think I can echo what everyone's mentioned here. I think Dan, Andrew, and Mark have all hit all the salient points. The last thing, one more thing that I would add here is that you have to be building on something that's compelling, that's really going to solve a problem that will make an impact. And I think we're seeing that now. Sam Altman came up with this concept of go find a small niche of people who have a problem and solve that problem, and then scale from there. The environment and the playing field is changing significantly with the advent of AI, and they are meant. I think we're at a point now we're seeing this new AI revolution, similar akin to the Industrial Revolution, but even times 10x, right? And I think it's important for you to really know that, when it comes to our fund, we look for startups that are generating revenue, and I think that's important for us as an emerging fund. As you heard from Andrew, he's on like fund 2, fund 3. in our shoes here, we were syndicating before. We had experience with the angel investing, and now from a fund perspective, there's a larger hurdle for us to overcome, and that's where we're looking for those startups that have revenue, right? I think at some points we'll go in earlier stage, and a lot of VCs, by the way, have been forced to go earlier because a lot of the LPs have now gone in and are able to get directly to startups because of just what we saw in COVID, right? Now LPs were getting exposed to startups, and they wanted to go in and invest directly. It is risky, but that then caused the VCs to then come up a little bit, go down the stages to a more earlier stage. So that I will share with you that it's important for us to see a revenue, because that's going to really show us revenue, and then you're solving a compelling problem, and that the founders got conviction in the problem they're solving really makes sense to us, and aligns with the size and the multiples that we're looking for.
I would say it's a bit of a scary time to be. Can I just jump in? I think it's a bit of a scary time to be a growth CEO, and there's just never been a better time to be an absolute raw seed. Let's start a company tonight, founder. I think that I've never in my life seen so many seed funds. When I was a founder in the 90s, there was no list of angels on the internet. You know, Ron Conway, like Topher was in diapers, so it was just Ron by himself. You know, there was no Ron Conway copycat. There was no Gangels. Like what you guys have done is extraordinary. So there's never been so much damn funding for the early stage. The valuations they're giving is still crazy founder friendly, uncapped notes, safe notes, whatever, no governance. So it's a good time for that. The other time, it's like if you were to, create an app right now, you could make the DMV, Department of Motor Vehicles, from a building into an app overnight. And of course, they would never buy it because, but I think they should give them all universal basic credit and get them out of there. But it's so easy to make a startup right now. There's a confluence of conditions that exist right now that never existed before. You can make a copy of Kayak and say, we're not going to charge the hotels, car rentals, or airlines anything. Just buy it with our credit card. So you can have all these crazy Trojan horse things. You don't need to have a $500 million liquidation stack from VCs to build something really amazing. The world is broken and it needs to be fixed. And you can basically Palantir every single idiosyncratic industry and get funded by early stage and build a profitability and maybe ignore all of this VC, nonsense. So I just think it's an incredible time. I think that a simple thing is to say, let's make some software that automates a human workflow and APIs into a bunch of data sets that brings that data back into decision tree. Do I go left or do I go right? And maybe you're replacing one human job. You price your software cheaper than her or him. Maybe it's 1, maybe it's 12. You're fixing, talk to your customer and pivot like YC advice, talk to your customer, make things. And then maybe I'm not so interested in that. I mean, it's good to reposition those people. Saying that we're getting rid of jobs is like saying we're going to close the patent office. There's no more ideas. That is completely, idiocy. So if you can repurpose and reprovision people to a different part of the org because the software is doing it and better and no fingerprints, fantastic. What's more interesting to me is to say it would require 2,000 people to read all these documents and pull all this information out and blah, blah, blah. With NLP, natural language processing, and all the changes in tech, and the ability to write software with software, that's what excites me the most is how can I do something for someone in the Fortune 500 that was just not commercially viable to hire an army of people to read all those documents the night before the court case? How many movies have you seen? They bring a dolly of boxes. They're like, oh, we got to read this before deliberations at 10 a.m. down here in Georgia. That's ridiculous. The computer should read it. So I think if I were a founder today, I would say the world's broken. Find something I can fix. Get off this angel money going at a valuation that my next round will be an up round. Be sensible. Don't let anyone invest in your company unless they can add enormous value. And it's just like literally never been a better time to be a founder. If you made Kayak 100 years ago and you got hooked on the addictive drug of venture cocaine and you're burning $5 million a month, get an Elon in there and whack everybody and get back to a new company. So I'm all for optimism around being the new founder that's founding a company this summer and going out and closing around at the end of August.
Andrew, to quickly amplify your point about the availability of capital, I think the stat is there are 4 times more funds today than there were about a decade ago for seed stage investment. So you're absolutely right. And I've certainly on my desk seen hundreds of companies that sort of describe what you're evoking here in terms of how easy perhaps not hard, but how available it is to create those sorts of ventures today, especially with
it's more than that.
AI.
It's more than that. When we started investing out of Fund One, we were one of 40 2 and 20 VC funds in New York City. I ran the San Francisco office. We had an office above Bagatelle in the meatpacking district. The number of funds in New York is more than anyone can count. It's got to be 1,300, 1,500 VC funds. They came up all in Hell's Kitchen, in the .com days, and they all put their ties back on and went back to Wall Street in 2001. There's got to be 1,500 VC funds that walk the streets of New York every day. We were one of 40 in 2012.
Yeah, exactly.
No wonder the valuations are stupid.
Exactly. What I'm hearing, though, and what I think we're all experiencing on this panel in the audience is that, fundamentally the VC market has changed and has changed irreversibly. So when thinking about the founder perspective today, we were both, all talking about how it perhaps is as easy as it's ever been to be a founder, but how do we think the fundraising process has changed for founders from a mechanical standpoint? Has the value of networking changed? Has the sensitivity of geographies changed? As all of us as investors on this panel, how has the fundraising process for founders changed, do we think?
Well, in terms of, say, the early stage folks, to follow on Andrew, yes, there is a lot more opportunity. There's a lot more funds. There's a lot more angel investors. And the location is, well, still important, is becoming less of an issue. I mean, you look at all of the large angel groups today, and every one of them has a very strong virtual component. Tech Coast Angels, I'm in Southern California. It's kind of the big boy in Southern California. They don't do in-person deal flow anymore. They do all of their pitching virtually. Their only in-person activities are social events, which then goes into the network question. And my belief on network is spending a lot of time building a network. You're probably better off building something of value. The network will follow as you create something of value.
And I'll take the contrarian view. I think it's fine to, get in your cave and build something, and the network will find you, and that'll work. But then you need someone in the orbit of the company that spend their life on network. I think network is everything. I think in a world of Skype and stuff, your idea is worthless. I don't mean your idea. I think ideas are worthless, and execution is everything. And I think that part of execution is getting fundraising right. So fundraising is, an art and a science, and that's a huge part of execution. So it really comes down to team. And I think most early stage startups pivot. And so if you're an early stage investor, and although we're not advertising that we do pre-revenue with people we don't already know, in a world of early stage investing, even if you have 500K of MRR, most companies pivot. And what are you left with in a world of pivots? You're left with the management team, the market they're going for, and hopefully you can apply that technology, post pivot. So I think management are the most important things. Like if real estate is location, I think startups are, and VC funding, LP investing, whatever, angel investing is management, market, technology, in that order. And if you pivot, you've got the management that was born to do that industry. So that's good. And then hopefully you've got some technology or enough cash to handle 3 more pivots, and abort the technology and maybe save yourselves.
Yeah, I'll agree with you on the team aspect and the execution. Absolutely. However, I think when you start looking at different sectors, you're more in the AI space, the IT space, the SaaS space. When you're on the hard science side and you're putting physical pipe into the ground, putting concrete down, your opportunities to pivot are a lot more limited.
Yeah, they can be very expensive and punishing. That's what we learned getting into some of those deals. I think CVC corporates, and I've written a book on it, so I know a lot about it. We raised money from a bunch of corporates, but they were like plowing into venture capital more than ever. Like hardly a deal was getting done without some CVC corporate venture capital group. But especially when you're dealing in like, dropping a pipe in the ground or dealing with real science and atoms rather than bits. I think large corporations are even looking at who your customers are. Can be a smart sense of a smart alternative to fundraising when all the lemmings are chasing the AI buzzword. Say who is it that really needs? Who am I solving for here? Maybe they could throw some money in, or maybe I could negotiate like a 3-year upfront licensing payment, and I could fund the business through my customers.
I will just add one more thing, Dan, if I may. You want to add something, Dan?
Oh,
Okay,
no,
go.
I mean,
Yeah.
I think it's, I agree with all the points, and I like the different perspectives. I do think it does depend on the business, but my personal experience with networking, it makes it like absolutely critical. I know for my own startup, and I went through an inception to exit story, we never would have got funding without us getting out from behind our desks, out of our coding bubbles and meeting people. Not a chance. And we ended up recruiting people on the executive side, and it's just so much about serendipity. I mean, people, everyone kind of asks about, oh, does location matter? And I think it sort of always is a proxy question for, well, do I need to be in the Bay Area? And then you kind of double click into that deeper. It's really like, what is it about the Bay Area that makes it so magical? It's really just the concentration of stuff happening, and that the amount of serendipity that happens. Like you could be walking down the street and running into that VC that you had a brief conversation with 6 months ago, and you catch up, and he's surprised you're still alive and says, well, hey, why don't we go for coffee? And that kicks off your fundraising round. And I think that's the magic of the place. But I mean, at the same time, with respect to location, moving your startup to Silicon Valley, like it doesn't guarantee success. I mean, the fundamentals still matter. To Andrew's point about the importance of team, this cannot be understated. And specifically, we really look for velocity. We love founders that are experimental and can move through iterations of their startup as quickly as possible. We know most things are going to fail, especially when it comes to like marketing exercises, trying to take things to market. They're going to have to try out a lot of different channels, a lot of experiments. And we're always looking for, is there evidence that they could do that and they're okay with failing and moving on to the next thing? But yeah, maybe you have some more to add to that.
Yeah, I agree 100%. I think all the comments that are made were on point. Just remember, with the advent of AI, like the points you mentioned earlier, now there's going to be a proliferation of startups. We're going to see more startups than we've ever seen in history. So where that ends up putting the founders is the strength of their network, right? So I will add that the network component is going to be important. No matter how much technology we have, technology, I mean, we're hearing technology is operating now with technology, and you have AI agents and bots and whatnot, and folks are not communicating. Like you can have a company we are going to see that company where you have a $1 billion unicorn with just one founder, right? And what does that mean? The rest of your team are all going to be AI agents or bots, right? At the end of the day, the network component of entering into and engaging with customers, there's going to be that human aspect of this. And I think the human component of that networking relationship is going to be key in opening some of these doors. I've got one of the startups that we invested in, making those introductions to the people who have those funds in order to acquire that product, I think is going to be key. So think about that as you build your startup, you build your product. You want to make sure that you're able to go out and prove your your thesis right with your customers and be able to get customers to latch on and acquire that product. I think that's going to be key there.
Thank you all. I think we have to pause now and shift over to the Q&A session from the audience, but really appreciate everyone's perspectives and detailed thoughts and answers on this from different perspectives across the VC industry and investor sort of theses. So that was very interesting for me to participate in. I will move this, as I was saying, over to the audience and their Q&As. I'm looking through the Q&A section. If anyone in the audience wants to ask something, that'd be great. I do see one in the general chat. Jonathan, thanks for asking about if you think now is the time for LGBTQIA plus startups. I'll actually take this one because I work for Angels, which is the LGBTQIA focused syndicate in venture. Absolutely. It's always the time to do that. I think panelists here have mentioned that the ESG is a focus. It's not the primal sort of incentive for a lot of folks today to invest. So the only word of caution I have for you is to make sure that your wedge and your business model doesn't solely focus in on the LGBTQI plus identity or whatever you're trying to sell. I think it has to be underscored by very solid business fundamentals so that investors, institutional, syndicate, angel, etc., see it as a coherent and solid business that has venture potential and not just a really important and valuable safe space for folks within the community. So thank you for asking that, but it was a great question. Those are my first thoughts. If anyone in the panel has any additional ones, please feel free to add. But in the meantime, I will look for some new questions, such as Christopher Brown. Thank you for asking. Moving the team to Silicon Valley is great for access to talent immediately, but it is tough for burn rate. Any thoughts on that? And do you see that changing significantly?
I think if you've not lived in Silicon Valley and you put a decade in, then it's easier to operate from outside of Silicon Valley and just go back a lot. I think mathematically, it makes more sense to build your startup in Berlin where it's cool and cheap than in London where it's crazy expensive. And yet the graduation rates to more funding seem to be higher in London. So there's just like some facts in reality. But if you're gonna scale up with a lot of employees and you want to all be in the same office 7 days a week, I think Austin makes a hell of a lot more sense than SF to Cupertino. $4 million house, 2,000 square feet. Good luck with it.
I'm also seeing hybrid models where you have co-founder here in the US stateside and the other co-founder over in an emerging market like Bangladesh or Pakistan, where your burn rates for 25 people or 30 people are anywhere between 25 and 30K a month, right? And so you get a lot more resources, right? But again, there's the AI component that's going to help with that. But I've seen some of those models, right, where you have a hybrid model where you've got some folks stateside and others internationally.
100%, Mohammed. Yeah, to build on that, rewinding all the way back to 2015 when I raised money for my startup, and we very much did that hybrid model. We kind of kept elements of the executive were disaggregated. We had them in Denver. We had like a lot of sales competency in the Bay Area. But by way of background, I'm from Canada originally. We actually ended up putting our dev shop up in Vancouver. And it was just a way to be able to leverage the dollars. The Bay Area
and shred credits. You get like 66% back in cash 100%. On every one of those engineers. That's perfect.
Yeah. It was
QSBS in the US, but shred credits, that sounds genius.
Yeah, shred for the win. Another program up there called IRAP. So, I mean, if startups can take advantage of these incentives that exist in their local market, including arbitrage on, the cost for people to work for you. And like I definitely, to your point, Andrew, about sort of like doing that decade, that's exactly what I did in Silicon Valley. And I sort of decided, that was enough. I'm in Austin now. And I do think that is the way. You don't have to be permanently located there. It's really about, absorbing the ethos of Silicon Valley that I think is the important part. And then, taking that back to the local market and building, where it makes the most sense for you. And I would mostly encourage you to build in a location where you have access to your market. If you're selling to oil and gas companies, be where those companies are. If you're in biotech, be in the biotech hubs. So start where your customers are. That's the most obvious thing. And then yeah, just go travel to Silicon Valley. Be there. I think it's wise to go to events, network, but then get out as it suits you.
Yeah, I agree with that.
I'm
Be
gonna
where
hop
your
in
customers
here.
are.
Sorry, go ahead,
Yeah,
Mohammed.
Mohammed, go ahead.
Yeah, I was just going to say, being where your customers are at, I think is going to be, that is key, right? Where the funding is at. I mean, COVID showed us all that we can do that from anywhere, right? You can do demo days and pitches to your VC, to your LPs, anywhere, globally, and virtually. But the customer component, I think, is a key one, right? Being there, especially in the beginning stages, having that face-to-face time potentially with your customers for your, to prove out and to do your proof of concept and prove out your MVP, especially if you're earlier on, that's going to have exponential returns on you, right? For your startup.
I just want to interject quickly. We've gotten a bunch of questions since the first one. So in the interest of time, I'd love to just have one panelist take on each except one. And obviously, if anyone has additional thoughts, please tag in. But we'd love to start with this one. For those of us who are foolish enough to try to start a career in venture capital right now, what advice would you give? How would you stand out amongst a crowd of young talent trying to become VCs?
Right. Historically, in like the 80s, they were former consultants at like Monitor and McKinsey, and they never worked at a company as an operator. So let's just change the compensation model to venture. Then you, of course, had bankers that were able to raise money. These were all horrible, toxic people to have as board members if you were a founder like I was. Then it sort of became, VCs had 10 minutes of fame in the dot-com and they survived a lockup in the late 90s and, bagged hundreds of millions of dollars and then became the next generation taken over from the consultants and bankers running Sand Hill Road. These were kind of, classic paths. It used to be Harvard, Wharton, and Stanford. Stanford's very quantitative and not very diversified. That's like 80% of them go to Wall Street. So it's like not really a great place network wise and DNA wise, even though my brother's a Wharton MBA. Harvard's more entrepreneurial. That's not so bad. Stanford's kind of it. So, education, kind of matters. Then it's, I want to be Bill Gates and Zuck and be dignified to drop out, not finish a degree. So being the Mark Andreessen, Joe Lonsdale, Peter Thiel billionaire who then, invests more than Ron Conway, deploys 60 million, puts that as the anchor into the fund, and everybody wants to work with him. So institutions fund that. But, these are all like, comparing yourself to Brad Pitt and George Clooney. Is that your strategy to go out tonight? So what do the rest of us mortals do? I think a lot of people that have worked for us have said, let me basically work for you for free for a while, moonlighting on the side and prove myself. If you can bring LPs into a fund and that management fee is more than what you got to pay them, that is like the easiest way to get into an emerging manager. So be like, hey, I'm going to bring my, ex-girlfriend's dad into this thing or something. And that's like $1 million, 2% times annual management fee times, 10 years, that's 200K. Get me 3 of those and I'll reserve cash for you for 3 years. That's another way to do it. So maybe start off as an intern, on the side or something like that can be, a path to getting in. The more common thing is you're not going to be probably Peter Thiel mathematically, statistically, Peter Thiel, Joe Lonsdale, Mark Andreessen, but you can start a company and raise VC funding and get some real experience. And now you're better than the management consultant, investment banker from Wharton, and you're more valuable, whether things are going well or bad. You're a good person to have in the room as a VC. And maybe you even know something about tech and have a network.
Yeah, I can second that. And I think you should go down the path of investing as an angel, right, for a few years. And then before getting to a fund or VC or launching one as an emerging manager, I think you should start, go down the path of trying to syndicate, co-syndicate. You'll build a network there, and then you'll build some momentum around around having the LPs that can see your track record, right? Granted, it's going to be it'll be your it's a much smaller track record, but B, then you'll gauge whether this is a space that you want to get into, right? Because there is a responsibility once you launch something of this sort that you have a fiduciary right and responsibility back to your investors. So I think it's something you want to take a look at and be mindful.
With that wonderful answer, I think we're at time. For everyone who asked additional questions, our apologies for not getting to them, but I think everyone had some wonderful thoughts to contribute, so didn't want to cut those short. Thanks for the wonderful panelists for giving great answers. Appreciate your time. It's great meeting you all. And I will now turn it over to Nasheen to start off the really exciting presentations from the 5 startups involved.
Thanks, everybody. Thanks so much. Great job moderating. Bye, everybody.
Thank you.
Thank you.
Thank you, Philip, and all our panelists. On behalf of everyone who joined us today, we sincerely appreciate all of the wonderful insights and perspectives shared by our panelists. And with that, we will move to the next exciting part of the event, presentations from our high-value growth stage startups. Before I announce the startups, let's quickly go over the house rules. Each presenter will get 6 minutes to pitch, followed by 2 minutes of Q&A session. After each feedback session, we